Thank you everyone for joining today's Babylon Pump and Power Investor webinar. I'll soon introduce Managing Director Michael Shelby, who is on the screen already, who will provide an overview of the company's financial results as well as operational activities for the period. He will no doubt touch on that during the half year, Babylon transitioned to positive EBITDA, completed 2 strategic acquisitions, and improved operational efficiencies as the company pivots towards the high-end margin rental segment. Following the formal presentation, you will have the opportunity to ask questions. If you do have a question at any time, submit them via the Q&A button at the bottom of the screen and we'll deal with them at the end of the presentation. We will endeavour to get through as many as we can in the 5 to 10 minutes we do have allocated for Q&A. I'd now like to pass over to Michael, who will run through the presentation. Michael, over to you.
Thank you, David. Good morning, everyone. I'll click through our boring disclaimer and get moving. So about Babylon Pump and Power. Many of you may know who we are and what we do, but as a brief refresher for everyone, Babylon Pump and Power is a small listed company. We listed in January of 2018, and we operate in the resource services sector in Australia. We operate in key areas, specialized water management services, where we rent equipment, pumps, dewatering, and provide services around those areas. We do rental of portable temporary power as well, generally small power opportunities at mine sites, maybe 5 megawatt and below. We provide environmental industrial services through our Ausblast wholly owned subsidiary, vacuum trucks, high pressure pumps, and the like. And as we listed in January of 2018, we've grown organically and grown through acquisition, and we're always progressing, a pipeline of opportunities. We're focused in the rental area in the water management segment, and we also have some key opportunities in the hybrid power segment as well. So we're developing a small portfolio of critical services for resource companies. Key takeaways from our half-year results that we posted last week. It's been a bit of a year of transition for us. We've experienced a solid start. We've renewed our strategic focus on the water management and rental side of the business, and that's reflected in the numbers. We've also completed 2 acquisitions in August and in January, just after the reporting period, to expand those specialty water management and rental areas. And we've delivered business improvements on the maintenance side of the business as well. So we're quite proud to report that our EBITDA has returned to a positive territory. It's improved 269% for the group. That is an accomplishment to our people through the hard work and the efforts they've put in. Revenue has remained steady, and that's also key. A key takeaway there is the fact that we've transitioned and we've pulled back on some of the lower margin, high revenue maintenance business, and we've really grown the rental side of the business, which is higher margin, but maybe a little bit lower revenue. So to keep our revenue steady, we're quite proud that we're able to keep at that operating rate. Our operational cash flow, while negative, it has improved over last year's point in time measurement. We fully expect our operational cash flow to be positive again by the end of the year. This is just a reflection of timing of payments from suppliers or from clients and to suppliers. Our available funding at the end of December was 4.2 mil, and that was split evenly between cash in the bank and asset financing available through our bank. And we're also quite happy to say we've gone through our annual bank review. We bank with NAB, and all of our existing facilities have been renewed through that process. Bit more detail on the group operating results. Steady group revenue. Again, we've pivoted to grow our higher margin rental segment, and we've been able to maintain overall revenue, 269% improvement in group EBITDA. Another key accomplishment is elimination of about $4.5 million of convertible loan debt that we had. That debt was costing us about 12% per year. So being able to reduce that and eliminate that and reduce that interest expense, we've decreased our finance expense overall, and that's resulted in a nearly 50% improvement in our net loss. So we're trending in the right direction. We are continuing to grow our earnings, and this trend will continue to accelerate through the back half of the year. And we're quite proud of where we are right now. Achievements through the first half of the year. Again, strong earnings growth in EBITDA and operating cash flow across the group. We've grown the higher margin rental revenue up 59% during the period. We've strengthened the balance sheet through the convertible loan repayment. We're advancing our rental and water management strategy. We've successfully integrated the Resource Water Group acquisition that was made in August, and we've made another strategic acquisition of RBH Engineering, which will add close to 50 assets, highly utilized. They were traveling at about 72% utilization prior to acquisition. We feel like that's going to continue and increase, and that's just going to be good, higher margin rental revenue coming in. And both acquisitions were absorbed into our existing operational base with very little added headcount or overheads coming on board. You know, for instance, the RBH acquisition, we had one employee that transferred over, someone who is recoverable on the tools, working with clients. So that's the type of headcount we would bring on, which really doesn't increase our overall overheads. Also, during the period, we've rationalized our lower margin maintenance segment. So significant restructuring and rationalization of maintenance services has increased EBITDA by 341% in that segment. And that's also while we reduced revenue in that area to reduce our exposure. So we're doing a little bit less business in the maintenance services area, but we're doing it better and making more money off of it. And key was our Prime Power Queensland subsidiary, streamlining operations there. Elimination of the overheads has returned that to profitability, EBITDA profitability in the first half of FY23. In December, we took residency in our new facility. We've completed the transition in January to our new facility in High Wycombe. This is key for us going forward. We're able to put all of our operating people and assets under one roof, whereas previously we've been spread out amongst different sites in the Perth area and different workshops. It's been a inefficiency that we've, through the product of growth that we've had to deal with, but now being able to take a deep breath, have everyone in one spot, we feel like, number one, we will have operational efficiency, and number two, a nice new purpose-built facility with an 8-year lease. We have a bit of a plan, and we can attract employees that way, because labor is always difficult, but being able to get employees when you have a nice new shiny facility, it really does help out. Review of our segments. Specialty rental. Again, key acquisitions in the specialty rental side. We've expanded our rental and water management capabilities, again, through the Resource Water Group acquisition. And with that acquisition in August, we've since been awarded works with Rio, Strandline, and Mineral Resources. RBH Engineering was completed post-period end in January. But that will be a smooth transition into our existing rental model. And we feel like that's going to be a great contributor going forward over the next few years. What's key in both of these acquisitions is the vendors in both cases showed a lot of faith in our strategy and faith in what we're trying to accomplish here, in that the Resource Water Group acquisition was done with a significant amount of shares paid to the vendor. And both of these have had vendor financing. So there is some tie-in with the vendors as we work through that, but they like the story, they like who they're dealing with, and they see the positivity going forward. So that to me is a sense of endorsement of where we're going. We have a few experienced guys like that in the market who are buying into our pathway forward. We've increased our utilization across our fleet and expanded fleet with the RWG acquisition. So high demand, we see high demand for dewatering assets. And right now the market is very buoyant in that area. And we've also seen increased utilization in our industrial services business with the high pressure pumps and the vacuum trucks, really seeing a great demand at the moment. And we don't see that slowing down anytime soon. We are progressing more opportunities in water treatment and hybrid power. And that's something that will, I guess, stand by and see how we go with that. But we feel like we've shown a pretty good track record of progressing these type opportunities with the test pumping with Resource Water Group and also expanding our rental. This fits in there with our water treatment and hybrid rental options going forward, where we want to progress as well. Just a quick snapshot at the bottom there of the financials for the segment. Maintenance services, again, a year of hard work. Streamlining operations, elimination of overheads has helped us tremendously at Prime Power Queensland. They've returned to profitability during the period. The lower margin maintenance revenue was reduced, but even with that, we have increased the EBITDA, and the gross margin itself has improved 143% during the period. So we're doing what we've done, just a little bit less of it, but we're doing it better and with better focus, and that's the outcome of that. So restructuring and rationalization result in segment EBITDA improving significantly. Work in hand, we're in a fortunate position right now where we haven't been in the past few years, where we have good visibility for the next few months. We have work in hand and work coming through our sales process, our sales funnel. So we're expecting to continue on this trajectory for the foreseeable future. We see where previously we might see just a month or two ahead. Now we're seeing quarters ahead about work upcoming, clients trying to engage us early to secure capacity in our workshop for rebuilds. And this has given us the ability to be a bit maybe a bit more selective in what jobs we do, and making sure we're targeting the ones that have the right margins so we can continue with these improvements in the sector. A focus for management during the back half of the year will be reducing stock and inventory and trying to turn that to available cash that we can invest in the higher margin areas of the business. Maintenance segment financial results are below. A nice snapshot of our new facility in High Wycombe, purpose-built, 8-year lease. We've completed our relocation, and it's kind of a draw card for employees. And we've also had clients come through, and they've been suitably impressed as well, because it's been a long process, but our operations team really has something that they can work with and work efficiently to continue providing great service to clients and grow. So it has given us the ability to plan ahead and look at growing our fleet and our capabilities around supporting our fleet. And it's nice to be proactive, whereas we've been a bit reactive over the past few years as we've grown. Going forward, I feel like we're posed for continued growth. We've had earnings improvement across the group. Again, EBITDA has improved 269% during the period. Restructuring and rationalization of the maintenance segment has improved EBITDA 341% in that segment, and rental segment EBITDA is up 28%. There is a strong market for us. We're leveraging that outlook in the Australian resources sector. Mines with complex water issues are where we want to be. We do provide complex solutions. We're not an off-the-shelf rental provider. So having the more complex issues allow us to show our value and then also get paid for that value to clients. Tighter environmental regulations and requirements just make us all the more necessary, from test pumping through to water measurement and management, through to the back end with the disposal of water. Transition to clean energy. That's a position that we're taking with a very high quality equipment provider. So we're working through the process right now to try to have we will have a hybrid type temporary power provision available to the market. And again, it's been a slow process because we're going for quality over just trying to be a quick Me Too type reaction. And client capital restrictions, that fits into our rental model, and we just see that getting more and more onerous for clients to have access to CapEx. So being able to rent through OpEx and then solve their problems fits into our business model. We've improved our balance sheet, again, repaid the convertible loans, and we've completed our annual facility review with all of our banking facilities being renewed. Our focus is on water management and rental. The maintenance side of the business is not going away. It will be managed, and it is necessary to provide support to our rental business. And it's also necessary, and it's necessary part of the business for our clients as well. So we will continue to do that. We're just going to, like we've shown, do it smarter, do it better, and try to really have that segment hold its own. Key strategic acquisitions have been completed, and we feel like the demand will be there for more type acquisition work as well. So we've identified and initiated discussions and other potential acquisitions around the rental segment with water and with power, and they're highly complementary to the existing business. So we feel like we'll be able to integrate those should they come to fruition at a very low increase in overhead as well. So we feel like we've done a lot of hard work over the past 6 months to a year. The past 6 months are starting to show the fruits of that labor, and we feel like we're in a good position to continue to travel that path and have incremental improvements in our earnings going forward. We feel like the trajectory is on the positive note, and that'll pay off here in the back half of the year as we go forward. So that's kind of it as a summary, and happy to take any questions, David, if you have anything, or if there's anything.
Thanks, Michael. A number of questions have come through, and I love that photo of the new facility. Clearly a proud moment, but obviously something that attracts client and employee interest for sure. Now, a couple of questions have come through, so I'm just going to read them out as they've come through. So can you tell me a bit about the decision to pivot to the high margin rental segment, and how has this been progressing?
Well, the decision was quite clear. When we dig into the results, the higher margin rental segment is where we want to be, and that truly is in our core DNA and our background. The maintenance services side of the business, if it's necessary. So if you have a rental fleet, you need a maintenance services to support your own rental. Now, with that being a small company, trying to grow, being the minnow in the big ocean there, we have we've taken on work and provided maintenance services to gain traction with clients, and we feel like we've done a great job, and we have a good reputation there, and we've attracted key clients in that maintenance services area. But it is low margin; it's very capital intensive, working capital intensive. So we feel like we're at a point where we can take a deep breath, continue on that path, providing our current capacity and doing a better job. We've shown that in the results, but we need to focus our efforts on where the long-term growth is going to be, and the long-term delivery back to earnings, back to the business in the rental side. So it's quite clear on paper. We're starting to make that progression right now. In our half-yearly results, we show a bit of a rebalancing of the revenue, and we feel like that will also continue because the results we have now, we've put out, don't include anything from the RBH acquisition either going forward. So that'll start to rebalance in the positive favor for us as well.
Just touching on the acquisitions, both came one post period and one late in the period, so the numbers don't reflect truly through the books at the moment. What you touched on it in the presentation, but what do they bring, and what do you expect them to bring?
They're each a little bit different. So the Resource Water Group, they specialize in test pumping. So that's early stages in a mine development, and it's essentially bore pumping, putting bores down boreholes, proving water reserves, and early stages of a mine, or early stages of expansion. So it puts us in contact with clients very early in development. And RBH, the rental company there, that's pure rental. That is just increasing our fleet. And it came with key clients and key contacts. And what made sense there is right now, the world is still recovering. So the supply chain. So if we want to go out and buy 20 pieces of gear for our rental fleet, it may take us 6 months to a year to place orders, have orders fulfilled, and then have it roll into our fleet that we can then hire out. But a small acquisition like that, where it's assets, one key employee coming over, we get immediate impact, we get access to assets working immediately, rather than trying to deploy some CapEx and have it pay off in a year's time or 6 months to a year's time. It made sense for us to make an acquisition like that to broaden our fleet immediately. So one is the early stages with clients, and one is the here and the now and immediate impact.
And you touched a bit on in the environmental sector, and that is a growing market. And clearly, Babylon has specialty in that area. What sets you apart in that emerging space?
We're looking to do things a bit different. So on the back end for water management, kind of water disposal, there is technology around where it's kind of the brute force method, where you may want to dispose of water through evaporation. And it requires a bit of horsepower, requires burning a bit of diesel. We have some small applications where we've worked with a supplier. So instead of having the brute force method, it's a bit more of an elegant method that requires less power, burns less diesel, and still accomplishes what we're trying to accomplish. So from an environmental touch point, we're really taking our time to make sure we do it right, rather than rush in with some type of Me Too type thing. And then as well, going down the path of the hybrid power, trying to work with a very high quality equipment manufacturer, Australian based for Australian conditions, a big footprint, being able to go down that path rather than trying to say, well, here's a Me Too, and throw something out there and say, look, we're doing environmentally sustainable type work, but it might not be the best pathway for longer term commercial activities.
And in terms of the market conditions in WA and nationally, what are you seeing, and what comfort does that give you moving forward?
Busy, just across the board. It's very busy, so it gives us comfort, allowing us to continue to make decisions for the long term, because it is daily trying to manage customer expectations about fleet availability and labor availability to implement these dewatering operations. We're very, very happy. We are also trying to grow sustainably and conservatively. So rather than throwing too much at it and being left with maybe excess people or equipment, we feel like that every time that we've made a step up to increase our assets or increase our headcount, which as a side note, our headcount has remained steady last year versus this year. So we've had these improved results, and our headcount has remained steady. So instead of trying to grow unsustainably, we really are trying to be conservative in that type of approach. But as soon as we can get equipment, we're getting it out on hire, and it's a great place to be in right now to be able to grow that way.
Now, bedding down 2 acquisitions and everything is looking great there. In terms of, you did touch on that you are always keeping an eye open for other opportunities in the acquisition space. What's a perfect acquisition or acquisitions look like for Babylon?
Well, being a small company, we're targeting the smaller, privately held type opportunities that predominantly rental revenue streams. That's what we're looking for. We want to own the assets. We want to rent the assets, and with that, it's there's kind of an area right now where you have a vintage of small business that's been started and run over the past couple of decades in the resources industry, transition plans for owners in that private space, trying to look at their legacy and transition their business. We feel like we're in a good position because we have a great reputation. We're not a big bureaucratic beast. We are still a small company. We can relate to these guys, and we have great client relationships, and able to really kind of have that smooth transition over, but focused on the water management, the unique type power, But for us, we want money we want revenue and money flowing in terms of rental type revenue streams.
A question here, competitors. How competitive is the space, and who do you compete against?
It's funny. Sometimes it's kind of a gray area because your client can be your biggest competitor on a specific application. Clients always have the option to buy equipment or rent your equipment. So you kind of compete with your clients. But the competitive space, you have some, what I would say, more generic type rental companies. And, it's the guys that do a little bit of everything with, the example would be like a Coates Hire, who they have pumps, they have fleets of pumps, but they might not have the specialty pumps like we have, the larger or the higher heads that are really unique to some of the mines that we have to operate in. So you have that bit of competition, and then you have other specialized type competitors, and you have pump companies that they manufacture pumps and they rent their pumps, and that you compete a bit there. We are a bit unique in the fact that we go from the very beginning, where we might have bore pumps downhole, electrically driven. We would have submersible pumps, electrically driven, and then large diesel pumps on the back end. And there's very few companies that offer that total package. So when we're talking to clients or a mine site that has a need across all those aspects, there's only a few people out there that have that type of capability to put their arms around the entire package there.
It's always an interesting one with contracts and how you can talk about contracts, because a lot of your contracts, as I understand it, start off as a short-term deployment onto a mine site, and that in itself may not be deemed material for the ASX. When you sign a client up, particularly on a water maintenance or a rental contract, what's the general longevity of that relationship? I know it might start as a month by month, but is there a general time frame of how long you stay with that client?
When you provide the more specialized type pumps, it tends to be a longer engagement with the client. It's a bit more sticky. So if you have more generic type pumps, say like a standpipe or a little transfer pump that you may be able to get from a Coates or from us or something like that, generally it might be a small term kind of multi-month type opportunity. But we have examples where some of our large 1,000 horsepower dewatering pumps would go out. A client would say, look, here's a PO for 3 months. And now 18 months later, we just get the rolling purchase orders that come through. And the fact that it's 16-ton piece of equipment, it's sitting on a pontoon in the middle of a piece of water there. You get that sense of comfort that it's critical for the mine site to operate. It's not just going to come back. But clients sometimes prefer to operate that way. And again, we're flexible because we understand the business and we understand the industry. We know that, for instance, I had temporary power applications that would go in for a temporary 1 year. We're 5 years later, and it's the same equipment providing the same power with temporary in brackets, because that 1 year contract has now been renewed multiple times. So
and does that make it challenging?
Business helps.
Yeah. Does that make it challenging when you're reporting contracts or not being able to report contracts because they're not deemed material, but and the industry knows that they are actually long-term contracts?
Yeah, it's tough. It would be nice if all my contracts came in with a 2-year period and of a value that were met our materiality threshold, and I could put it out there. But some clients are very astute in the fact that they may try to say, look, we know we're going to keep it for a long time, but give us a proposal for 6 months or 3 months, and we'll just keep re-engaging that. And also, it kind of keeps their name out of the announcements as well, because when it's material, I have to kind of give a counterparty and that sort of thing. And people just kind of like operating a little bit under the radar sometimes with that.
Now, final question. We do have a couple more questions, but we are running out of time, so we might deal with them offline if that's okay, because one's a little bit more related to forecasting and I don't want to get you into trouble. Final question, the building. Are you noticing efficiencies? And give me, if you can, some practical examples of efficiencies at work.
Practical examples. So previously we operated out of a facility in Forestfield. We grew, we took the facility next door, but we still continued to grow and ran out of space. So we've had to rent other equipment storage yards throughout the Perth area. So when we're trying to get a piece of equipment ready for hire, we might have to organize a truck to bring a pump from one part of the Perth metro area back to our workshop so we can give it a final once over and test before we send it out to a client. And it just creates some double handling and some, it becomes a bit of a safety issue as well, trying to double handle them and have all the extra moves via crane or forklift. Whereas now in our facility, same job, less man hours, less movements, it's safer, it's cheaper and more efficient for us to get out. So those type little things, not only does it help not having those costs incurred, but also employees just think, okay, it's a whole lot easier to work here. It's a whole lot easier to work in this facility, and it doesn't burn them out.
Final question, answered beautifully. A transformative period for Babylon Pump and Power. Clearly a visibility ahead of what's to come and giving you comfort of what's to come and the exciting things, bedding down 2 new acquisitions that fit seamlessly into the business. Look forward to following the progress, Michael. Thanks for your time.
Thanks, David. Thank you, everyone.
Thanks, everybody, for joining today's webinar for Babylon Pump and Power. If you do have additional questions or would like to talk to Michael in person, his contact details are on the screen, and he would welcome the opportunity to have a chat to any investors, or if you're in the Perth area, maybe come down and walk through the new facility. Thanks, everyone. I hope you had a great day, and we'll keep watching Babylon Pump and Power.